Hi, welcome to Let's Talk Bonds, the weekly bond podcast from INR Bonds. I'm Arjun Patsati. And in Let's Talk Bonds, I take investors and financial advisors through all the options available on fixed income investments to give them the best risk return profile for their investments in, uh, in the current economic and fixed income environment. And in this podcast, I'm going to talk to you about the importance of secondary market liquidity for investors in fixed income. And if you're investing in bonds or even in mutual funds that anyway invest in bonds, it's very important to know that what is the kind of liquidity profile of the bond or the fund. And I'll tell you why. And then when you look at bonds for the negative investments, and bonds have been giving very good returns in comparison to all other products. It's you would understand why secondary market liquidity is very important, and you would need to judge secondary market liquidity or check with your whoever is selling the bond whether this bond can be sold down even before maturity. Just before that, if you're a financial advisor, log into INR Bonds and get into our partner page where you can get the best fixed income solutions for your clients on bonds. We have a exclusive partner pay program for financial advisors where INR Bonds provides pre transaction and post transaction services. And obviously, INR Bonds is the most in terms of content and knowledge, in terms of information. And our proprietary risk score is extremely important for bond investors and financial advisors to judge the risk and return of the bond. Visit inrbonds.com and sign up for partners.
As a financial advisor, my biggest responsibility is to help my clients make the right investment choices. Now, with INR bonds, buying and investing in bonds for my clients is quick and easy. With my guidance on bonds, my clients are happy and I'm getting new business every day. Register as a financial advisor on inrbonds.com to help your clients invest and save better through bonds.
Back to Let's Talk Bonds. Just before I get on to the main topic of why secondary market liquidity is important for bonds, the levels in the markets in the market GSEC yields 2 and 3 year are below 6.75%, while the 5 year is at around 7%. 10-year yields around 7.2, 7%, and 40-year bonds are around 7.5%. State development loans are around 10-year yields are around 7.7%, 65%. Bharat bond ETF, we have 3-year Bharat bond ETF is below 7%, just around that. And 10-year Bharat bond ETF is closer to 7.45% down in yields. And this in terms of corporate bonds, the AAA corporate bonds, 2 and 3 year bonds are in a range of 7 to 7.3%, depends. And 5 and 10 year bonds in a range of 7.5 to closer to 8% or higher, depending on the bond. And if you go down the rating scale, the yields are higher. And in terms of private placements, we had Navi FinServ, which is the new age fintech company, issuing 2-year bonds at 9.5%. Edelweiss Investments, again, part of the Edelweiss group, raising 2-year bonds at 10%. Tata Capital Financial Services, 2-year bonds at 7.21%, clearly. Sundaram Finance is issuing 3-year bonds at 7.4%. Kotak Mahindra is issuing 3-year bonds at 7.38%. Kotak Mahindra Prime. Axis Finance is issuing 3-year bonds at 7.5%. And Power Finance Corporation, the PSU, is issuing 4-year bonds at 7.13%. So This also shows you that what are the bonds that are which are lower rate in terms of yields are able to get those yields because of institutional investments, and these bonds can be termed as pretty much liquid bonds, whereas bonds that are in higher yields are not as liquid because they may not be taken up by institutional investors, which institutionals include mutual funds and insurance companies and banks and other institutions. Um, However, having said that, also some of the factors that one investors need to look at for secondary market liquidity, especially in higher yielding bonds, because investors and financial advisors are searching for returns that can beat inflation. And what they need to understand is that what is the kind of liquidity available in the secondary market for retail investors. And some bonds are pretty much liquid, and some bonds are completely illiquid. And the investors who believe, or financial advisors who believe that investment, it's okay because they're going to hold the bonds to maturity. It's not okay. The reason is that um, the risk if of a bond that doesn't have liquidity is much much higher than a bond that has liquidity, and the reason is clearly that it shows that if a issuer wants to refinance their issue, and if there's any stress in the market or anything that is happening, then they will not be able to get that issue going, and the bonds could come in for severe stress, and maybe the company can even default. And that's classically what happens to many of the bonds that have defaulted, or funds that have really suffered in terms of not able to pay investors, like Franklin Templeton, because they bought bonds that were illiquid and just could not be sold when investors needed the money. And the companies could not reissue bonds to investors, and institutional appetite was completely absent. So investors also need to check whether if it's one single group, how many companies are issuing bonds from the same group. If there are many companies, then clearly there will be risk appetite, will be appetite for taking up more bonds from that company, even by banks and institutions, will be very low because they will hit group exposure limits. So, and hence companies, while individual companies of a group can show some reasonable leverage, but overall group leverage is very important. And companies and issuers that are growing very fast through debt, through issuing lots of more and more of debt. That means there will be, every time a bond is issued, there will be another bond issued, like the government bond. Like government borrows every week, but government bonds are very liquid. And the reason is because banks, insurance companies, provident funds, and appetite from even foreign investors are always there. And RBI is there to support the bonds if in case it turns in liquid. Whereas in corporate bond, this is not available. So hence, companies that are borrow consistently, for example, every week or every 15 days or every month, then liquidity is much lower. And also investors may not be able to get they have to sell the bond in the secondary market. They might not be able to get a in price as well. So hence, it's very important to know all this. And best place to know all this is obviously INR bonds, because when we are curating our bonds on our Quick Invest platform, or when we do our risk rating, one of the primary consideration for the bonds is what is the secondary market liquidity for the bond. And it's not even this kind of rating profile is not even available for any institutional product as well. And INR bonds is very unique in looking at secondary market liquidity. And we tell investors exactly what is the risk of the bond in case. And and we also say that if these the bonds are lower risk, that means you can easily sell the bonds in the secondary market and without too much of a cost of selling. And investors can actually make money on the bonds or not lose, or even a holding period return will be very, very good. Uh, Whereas in other bonds, which typically even yielding higher, may not be able to be sold and also the cost of selling will be very high, and this could hurt investors' returns. So watch out for secondary market liquidity always before investing in a bond. Thank you very much for listening, and do not forget to download our app, Quick Invest by INR Bonds. Curate the best bonds on offer, give the correct risk profile through our own proprietary rating model, risk rating model, and giving you the most information, transparency, and the best in-app investment process. Download the app now. Thank you very much for listening in, and do not forget to subscribe to all our podcast channels. Yeah, see you next week.